Be Wealthy and Smart, episode 1225.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about why it might be time to take some money off the table. Now, I'm not a short-term trader. I'm a really long-term trader. I definitely don't do a lot of tactical moves, but when I see a headline on CNN like this, it really makes me think we're about to have a pretty deep correction. The headline that I'm talking about said, "The Dow is on pace to do something today it hasn't done since 1897. Yeah, the Dow is on pace for its best run in 126 years. That tells me we're a little bit on the frothy side. Things are about to correct fairly hard. Now, I'm not calling for a crash. I'm not calling for anything serious. But I am saying that when I look at the sentiment indicators, we are at extreme greed. I mean, the maximum level of greed on the chart that you can reach, we're there. That means everyone believes that the market's going to continue to go up, which is usually when it goes the other way. And that's what I'm talking about today. So this article says, if the Dow closes higher yesterday for a 14th consecutive session, that would be the longest run of consecutive gains since May of 1897. Should the Dow end the day higher, and for the 15th straight day on Friday, that would mark the index's longest daily winning streak ever. The blue chip index's run is already at historic levels. The Dow on Wednesday notched its 13th straight day of gains. The Dow is up 7% for the year, was 50 points higher and rising 0.2% on Thursday after rallying in recent weeks as cooler than expected inflation data has investors more optimistic that a soft landing or no recession could be in the cards for the economy. That in turn has spurred investors to snap up shares of cyclical stocks or shares of companies that are sensitive to the economy. So basically what's happened is that the NASDAQ took off so sharply and so strongly this year that the Dow stocks really lagged. And so now we're seeing the professionals are picking up some of the cyclical shares, not the fast-growing tech shares, because they haven't increased as much as tech has. And also strong earnings and investor optimism about tech, particularly with interest in AI, has helped stocks just go a little bit crazy this year. That's added a huge amount of value onto the stocks that are talking about AI. The article also says the Dow's rally bodes well for Wall Street since it suggests that the market's gains are continuing to broaden beyond just the 7 big tech stocks that have dominated the market this year. And that's true. We've had such a narrow market with just 7 stocks that are all tech companies, mainly, again, benefiting from artificial intelligence, AI, that is driving the big gains there. It's no surprise because AI is going to be like the .com bubble, or putting .com at the end of a name, a business name in the 90s. That was almost a guarantee that your stock value would get a huge boost. In the same way, just talking about having an AI strategy in your company is going to give your company's stock a boost. Now, in regard to the Federal Reserve, we had the Federal Reserve raise interest rates on Wednesday to their highest level in 22 years. They've raised interest rates from 0.25% to 5.25% in just 16 months. And yes, we've seen inflation come down, and that's mainly due to energy prices coming down, but food prices have not come down that much. With the Federal Reserve raising interest rates to its highest level in 22 years, the Fed is still saying they haven't ruled out a rate hike later this year. Although we'll talk about what the market is telling us about that in just a minute. But first, Rise Williams, chief strategist at Spouting Rock Asset Management, said, "We believe the market may underestimate the Fed's resolve to keep rates higher for longer. This is a Fed that cares more about inflation than recession." So the market is currently pricing in 6 rate cuts in 2024. That's right. The market is pricing in 6 interest rate cuts in 2024, although it's not clear the magnitude of those cuts. You can look at the CME FedWatch tool and see that that's what the prediction is. And some investors say that the central bank is unlikely to pivot as soon as Wall Street expects or as quickly. Mike Sanders, portfolio manager and head of fixed income at Madison Investments, said, "We believe the market is a little ahead of itself, expecting significant cuts to the policy rate in 2024, given the overall stickiness of inflation and signs that certain parts of the economy are re-accelerating, housing being one of them." Yeah, housing is definitely coming back, as I told you it would. All these people saying the housing market was going to crash got it completely wrong. We have about 3 years of very speculative gains ahead of us because we will have something in our future that is going to cause the Fed to cut rates. The market knows it. It's predicted in 6 rate cuts in the future. If I had to guess what it is, I would say it's likely the commercial real estate market, which is in really bad shape. Commercial office space, malls, etc., really having a difficult time. Lots of vacancies, foreclosures coming, and that's going to impact the banking industry. So banks are not out of the woods in terms of losing deposits and having financial troubles. So I think we have some kind of a crisis in our future, maybe around the September time horizon, that causes the Fed to have to back down and cut interest rates going into next year, which is going to spike another housing boom and incredible speculation in housing because we still have low inventory, high demand, and if we get lower interest rates, well, it's just about to get crazy. So that's what I think is happening here. But I think right now what we're seeing is we are at the higher end of where the market can go. Sure, the market can stay up a little bit longer, but it's looking very overbought, way above the 50-day moving average, and just out of the norm of where it normally should be trading. So I think the market has to pull back soon. That could happen now. That could be waiting for September with this other news that comes in. I don't know the timing on that, but I do know that we are looking overvalued here. And if you have some speculative money, I would use now to take some off the table. This is not the time that you want to be invested in companies that have no earnings when the market is moving back around to cyclical stocks. So if you have a long-term time horizon, it's always okay to dollar cost average in, but just be aware if you're trying to be tactical, it looks like we're getting close to some kind of a high here, and I would expect a pullback of at least 10%. So now would be a good time to take the speculative money off the table and save some cash for when prices may be a little bit lower this fall. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And all of my podcasts are on my website at lindapjones.com/podcasts. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.